This video is titled Investing in the Stock Market for Beginners and the State of the Market. I think that the stock market right now, if you're a beginner investor, this is one of the weirder times in the market. And I'm going to go over in this video all the main bullet points for why I think this is a weird market. Go ahead and take a look at the screen here. We're going to be going over a lot of the market valuations for both large cap, mid cap, and small cap companies and comparing them to traditional valuation metrics, not only looking at their forward PE ratios, but also looking at things like the pegged ratio, like the price to earnings growth ratio. And we're going to get over all of that in this video and talk about where I see value in the market, and if I was a newer investor, what I'd want to be looking out for. So I hope you guys enjoy this video. My name is Jordan, the Millennial Investor. Check out links down below in the description to referrals to Yada savings accounts, credit card referrals, Robinhood, Webull, M1 Finance. Get up to $50 to get signed up with that. Subscribe down below if you haven't already. And if you're a newer investor and you're wanting to look for the category, at least in my opinion, on where I find value, we're going to go over that in this video. So let's go ahead and jump straight into it. Now, looking here at the screen, if you're a brand new investor to the market, you might not know what a forward PE ratio is. And if you're not familiar with what a forward PE ratio is, let me go ahead and give you the Google definition of it. The variation of a price to earnings ratio is the forward PE ratio, which is based on a prediction of a company's future earnings. Earnings used in the forward PE ratio are estimates of future earnings, while the standard PE ratio uses the actual earnings per share from the company's previous 4 quarters. Now, if we go back to here, basically in English, if you're brand new and you don't know what that means, the higher the PE ratio, the more companies valued, okay? So basically you take the price of what a company trades at, let's say $100, and then you divide by their earnings of next year. Let's say they're going to earn $5 in earnings per share next year. That's what they're projected to earn. 100 divided by the earnings, the share price by the earnings, you're looking at a forward PE of 20. Now let's say the exact same thing, the share price is 100, but they're only going to make half of that. Instead of $5, they're only going to make $2.50. Well, what is 100 divided by 2.5? Don't worry, I can go ahead and tell you. You don't have to put in your calculator. That is a 40. And so in that scenario, which is the better deal? The one that has a 40 that makes less profit, or the one that has a 20 that makes more profit, double the profit in that scenario? You obviously want the company that has the larger earnings and the smaller price to earnings ratio, right? So basically it's a simple and quick way for investors to get an idea if they're getting a good deal or not. Now let's go ahead and look at these 3 categories. So the S&P 500 large cap is currently 20.6. I'm scrolling through this chart with my mouse, and you can see that the last time we saw anything up towards this level was back in the dot-com bubble, up towards 2000, 2001, and that's the first time we've seen anything even close to this level in pretty much 2 decades. Now the norm for this over the last 2 decades or so, you can see the average is probably around a 15 or so. There's times where it's a little higher, times where it's a little lower, like during the financial crisis. But you can see, generally speaking, around a 15, 16 roughly is where you see the mean. You see the average of this. But right now, we're currently trading at 20.6, far above the average. Now, if you don't know the difference between large cap, mid cap, and small cap, let me go ahead and explain real quick. I'm gonna go ahead and use Vanguard as an example because that's a retail trader favorite. What that means, when you think large cap, think your mega giant corporations. And I'll show an example. Go ahead and take a look at this. So this is the S&P 500. Think of your ginormous companies. You probably know every single one of these by name. You probably know Apple. You probably know Microsoft, Amazon, Facebook, Google. These are ginormous companies, hundreds of billions, maybe trillions of dollars in size. These are ginormous companies that you all know and love and probably spend money at every single day. Now, if we go smaller, if we go to the mid cap, now these are kind of your middle companies. These are ones that you might know some of them. You'll probably know a few by name, but you probably won't know all of these. So this is a mid cap fund. So let's look at this. So this has some that I noticed by name, like I know DocuSign, Chipotle. I know a few in this list. I know Digital Realty Trust, but I don't know all of them, and it's starting to get a little bit more thin. Now let's go further and let's look at small cap. Your small cap companies are ones that are smaller in size. These are a fraction of the size of your giants of Apple and Microsoft and Amazon and those big names. If we go to the small cap fund here as an example, you probably don't know any of these by name. And if you do, you may just probably know 1 or 2. I'd be really surprised if anybody knows all of these 10 companies by heart. I only even noticed a couple just off just basically looking at it. But if we go back here and we look at the large cap, it's currently 20.6. Now, how does that compare to the other mid cap and small cap that we just talked about? Now, large cap is 20.6, but mid cap is 16.6. Looking at the average versus historical rates, it's pretty much right in line. It's actually, you could even argue, it might even be a little bit below the average. Just the other day, just earlier this year, we were up towards 20. Now we're trading at 16. So there's got to be some decent deals in the mid caps. You can see that the large caps are really pushed high in valuation. Mid caps are kind of all right. But what about the small caps? Let's go ahead and look at that. Looking at the small caps are as low as 15.6. And you can see that the average here, I'd say, is probably about a 17 or so. And right now it's trading at 15.6. And look at that downwards trend over the last year and a half or so. You can see that the last 2 times that we've really only been below this number, where my mouse is, where that line of 15.6 is, over the last, say, like 10 years, ever going back to 2011, 2012. There's really only 2 times we ever dipped far below that, and that was at the end of 2018, right where my mouse is, and that was because of global fears about the trade war, where virtually all stocks went down in price. And then the second time, you see right here where my mouse is, right here. That was during the COVID-19 pandemic, when all stocks, including small cap companies, just went into a free fall. Everything went down and down in price. And so this is the thing. When you look at the market indexes, when you look at the market as a whole, you look at things like the S&P 500. And if we look at the last year or so, let's go ahead and look at this chart. This is VOO. This is the S&P 500. It is up and up and up and away. Let's look at the 2-year chart. It is up, higher and higher, getting pushed higher by the day, breaking record after record. It seems like it pretty much never stops. Looking at the 5-year chart, once again, it's starting to get higher and higher. What about the 10-year chart? You get the point. It is just a straight line up and to the right, pretty much nonstop. There was one small hiccup in 2018 and 2020 when the trade war and the coronavirus took place. But other than that 2 little small hiccups, it's pretty much a straight line up for the last 10 years straight. And so this is where I find opportunities in the market. Okay, and looking at my Fidelity portfolio here, you can see that I have 5 positions, and where am I currently invested in? The highest position in my portfolio is Chewy. Well, let's see what the market cap of Chewy is. You know Chewy, the company that sells dog toys and pet food, and basically the Amazon of pets, I think a lot of people call it. At least that's what I refer to it as. It has a market cap of $27 billion. Kind of a smaller mid-cap company, but what about the others? My second largest position, Corsair Gaming. What is its market cap? It is currently $2.31 billion. Okay, let's keep going. The third largest position is iRobot. We have 8,000 in that one. iRobot's market cap is currently $2.3 billion, about the same size. What about the next one? Tattooed Chef. Tattooed Chef's market cap, $1.4 billion, another small cap. And then the smallest one of all, we have CleanSpark, my smallest investment and my smallest market cap, not even $1 billion, only $600 million. And so you can see that, believe it or not, kind of looking at my positions, every single position that I have is pretty much a small cap company. The biggest one is Chewy. You could kind of argue that's kind of a small mid cap, kind of in between. But basically every dollar I have in the market right now is all in smaller companies. Chewy is the biggest, and $30 billion in terms of the stock market. I know it sounds like a crazy big number, but it's really pretty relatively small in the grand scheme of things. Usually people are talking about investing in something like Apple that's $2.5 trillion, not with billion, $1 trillion market cap. And so when you consider that Chewy's about 30 billion, it's really pretty small comparing to a lot of mega cap corporations like Apple, Microsoft, and Amazon. But you get the point. Looking at these PE ratios, it is incredibly skewed in your favor to invest in companies that are trading at lower prices like the smaller cap companies like I just mentioned. And this chart right here, if you want to pause and look at this, this is them side by side. So if you want to see a daily comparison of the S&P 500, 400, and 600 line by line, you can go ahead and pause the video and look at this, and maybe this can give you some valuable data. But moving forward, the next thing I wanted to show here, and what I thought was most interesting of these on the list, is I wanted to show the PEG ratio. This is what's the most confusing part of it all, is that if we look at the forward PE ratios, while valuations are stretched very high, the price to earnings growth, or the PEG ratio, represents the PE ratio with a twist. It also factors in earnings growth, how much the company is going to grow in profits over the next couple of years. And if we look at this number is dramatically lower. Usually anything under a 1 is considered to be undervalued. And if you look historically, you can see that generally speaking, I would say about a 1.3, 1.4-ish is about average. Anything usually above like 1.6, 1.7 is usually where you start to get into bubble territory. And anything under 1 is usually considered to be really, really cheap. And if you look at where we are right now, where I said 1 is considered to be a steal deal, anything under 1 is supposed to be a really good price. Well, right now we trade at 0.9. And so that's what's confusing about this market. Lots of growth, mixed valuations all over the place, in a market that looks like it's at its peak, but is it going to stop? Well, time will only tell. In the meantime, I'll be placing my bets, which is mostly going to be on smaller cap companies. There are a very few small amount of deals here and there in between on the large cap and the mid cap companies, but especially for the small caps, that's where I find value. That's where I think in 2022, we're really gonna see an uproar over the next year or so. But thank you guys so much for watching. Check out stuff down below in the description. Subscribe if you haven't already, and I'll catch you guys in the next one.